Hi guys, so today we'll be doing an accounting past paper. So let's just jump straight into it. So question 1, it says you must choose the correct word from the given brackets and then write only the word next to the question number in the answer book. Right. So the concept of limited and unlimited liability ensures that shareholders are not responsible for the debt of the business in the event of bankruptcy. So now the first key thing you need to ask yourself is, what's the difference between limited and unlimited? So when your liability is limited, it means that the shareholders are only liable to a certain point. Whereas when the liability is unlimited, then the shareholders would be liable for everything. So now if you read it, it says ensures that the shareholders are not responsible. So that would mean that it would be a limited liability. So in your answer book, you would go to 1.1.3 and then you would write there limited. Cool. So the next one says, when preparing financial statements, creditors will be reflected as trade and other. So then we have receivables, payables, and equity. So now when you're thinking about creditors is when we buy on credit. And then the opposite of that would be your debtors, right? So when we buy on credit, it means that we are going to pay them in the future. And then when you have debtors, it means that they are going to pay you in the future, which means that we will be receiving money in the future, right? So then from these two options, if we have creditors, it means that the answer would be trade and other payables. So then in 1.1.2, you'll write payables. Now the reason why it's not equity is amounts that are from shareholders. So when shareholders invest in the company, that would form part of your equity. Then the other thing that forms part of your equity would be your retained earnings. So that's why it's not equity. Right, so now the next one is the separate disclosing of significant items such as interest expense is an application of, is it prudence or materiality of the GAAP principle? Right. So prudence is all about making sure that your expenses and your liabilities are not understated. So that means that you do not say that you have less expenses than you actually have, right? That is the principle of prudence. And then materiality is about things that are important, right? So it's important and it has an impact. So based on that, the keyword here would be significant items, which would lead you to your answer being materiality. So then in 1.1.3, you would go and then you would write materiality. So now required 1.2, it asks us to analyze the transactions below according to the headings on the table provided in the answer books, right? Then it says indicate account debited and the account credited in the general ledger and the effect on the accounting equation. Indicate an increase with a plus, a decrease as a minus, and no effect as 0. Refer to the example provided. And then assume a favorable bank balance at all times. Cool. So the example says you bought stationery on credit for 3,200. And then you debited stationery, you credited creditors control, and then the amount is 3,200. The asset 0, owner's equity minus liabilities plus. So now how does the accounting equation work? So that accounting equation is your assets is equal to owner's equity plus your liability. And remember that your owner's equity is made up of your share capital and your retained earnings, right? Then remember that in your retained earnings, you'll have your profit and loss. So the profit or loss effects will be your income items and your expense items. Cool. So now remember, when you have an asset, when an asset increases, it's going to be plus on the debit side. So your asset is plus minus. And then your owner's equity and your liability, when it increases, it's on the credit side. So it's minus plus. So try to remember this T account, to remember that asset is plus minus, owner's equity minus plus, to know when it's debit or credit. So remember, it's always debit first and then credit, then debit, and then credit. So with the example, you bought stationery on credit for that amount. So your stationery will be an expense because it is consumables. So that will have an effect on your owner's equity, right? So the expense will have an effect on your profit, which means your profit will decrease, which means that your retained earnings will also decrease and your owner's equity will decrease. So that means it will be a debit. It's on the debit side because it's decrease. And that's why the debit here is stationery. The other thing is that it's on credit. So if it's on credit, it means you have a liability, right? So we are here with the liability. If you're buying on credit, your liability will increase, which means that it's going to be a plus here, which means it's going to be on the credit side, which is why we credit the creditor's control. So we decreased the owner's equity here and we increased the liability here. Cool. So now question 1.2.1 says that electronic fund transfer, so the EFT totaling 136,000 were made to shareholders, right? Being the amount owing to them at the end of the previous financial year, right? So the EFT has an effect on your bank account, right? So bank is an asset, right? So when you're making an EFT 2, it means that the money is coming out. So your assets are decreasing. So if you look at the T account here where we have the assets, if the asset is decreasing, then it will be a credit. So now you go to your answer where it says account credited, you will write there bank, and then bank is an asset and it's going to decrease. So now the next account will be the amounts that were owing to the shareholders. So when it's amounts owing, that will be a liability, right? So what is happening here is that they're settling their liability. So that means that your liability will go down. So if we're looking at the T account here, with the liability, it will decrease on the debit side. So you will come here and you will write shareholders for dividends, right? And it's your liability and it's going to decrease. And then remember to show that the owner's equity has a nil effect. Then the next one, the company received 450,000 for the issue of new shares. Cool. So when you receive an amount, that affects your bank, right? And then bank is an asset and it's going to increase because you're getting money, and it's going to increase on the debit side. So then you go to your answer book and you write on the debit side bank, and then here it's going to be an asset and it's going to increase, right? And then this amount is for new issue of shares. So shares will affect your share capital, which affects your owner's equity. So when you're issuing shares, your owner's equity is going to increase, right? And if you look at the T account here, an increase in owner's equity is on the credit side. So then you go to your answer book and you will write share capital, right? And it's owner's equity increasing plus, and then liability has a nil effect. And then the last one here says that the income tax assessment for the year was received, right? And the income tax amount of 338,200 exceeded the provisional tax payments. So this means that our income tax expense is going to increase, right? So this is an expense. It has an effect on the profit or loss, which has an effect on the retained earnings. Thus, it will affect the owner's equity, right? So this means that the owner's equity is going to decrease, right? Because your expenses are increasing. So when you're looking at the T account, owner's equity decrease is on the debit side. So you'll debit the income tax expense. Please write the full thing in the test. And then the second one would be your liability is going to increase, right? So this is a liability because you need to pay SARS more money than what you should have paid, right? So that creates a liability. So when you look at the T account, your liability is going to increase, which means that an increase on the T account here is this side, which is on the credit side. So you go to your answer book and then you will credit your income tax liability, or you can have it as SARS, right? So the income tax expense has an effect on your owner's equity, and it decreased your owner's equity, so you'll have a minus there. And then your liability increased, so you have a plus. And then remember, your assets have a zero effect. Cool. So question 1.3 says you are provided with an extract of the audit report for rock stones for the financial year end 28 February 2021. And then it says that you're required to identify the type of audit report that the company received, and then give a reason for your answer. So when you're thinking about audit reports, there are two types of audit reports. So there is an unmodified report, and then there is modified. So with an unmodified report, it means there are no problems. So the auditors did not find any issues. Right? And then with a modified report, it means that the auditor find issues. They found misstatements. Right. So when you have a modified report, there are three types of reports. You have a qualified report, you have an adverse of opinion, and then you have a disclaimer of opinion. Disclaimer. And then when you have an unmodified opinion, you will have an unqualified opinion. So when you have a disclaimer of opinion, that's when the auditors can't find enough audit evidence. So when they can't get enough information, like enough evidence, then the auditors basically say, we're not going to make an opinion because we don't have enough evidence. So that's the disclaimer of opinion. Then the qualified opinion is for when the misstatement, right? So you have a misstatement that's material, but it is not pervasive. So what that means is the misstatement does not affect more than one account, right? And then for an adverse opinion, that's where you have this misstatement that affects more than one account. So when you read the extract of the report, the report says that we conclude our audit in accordance with international standards on auditing, and then we are independent of the company as applicable to performing audits and with other ethical requirements as per professional code of conduct. The audit evidence we obtained was sufficient and appropriate. So because the audit evidence they received was sufficient, that will automatically cancel out having a disclaimer of an opinion, right? Cool. So the opinion. So we have audited the financial statements as set on pages 8 until 23. These comprise the statement of comprehensive income, statement of financial position, and the cash flow statement for the year ended 28 February 2021. So in our opinion, the financial statements present fairly in all material respects. The financial position of the business and as at year then ended. The financial performance and cash flows in accordance with international financial reporting standards and the requirements of the Companies Act of South Africa, right? So if now we had to identify the type of audit report, because the report says that the financial statements present fairly, we would then conclude that it is an unqualified report. So they're saying everything is presented fairly, there's no issues, there's no misstatements, and that's why we have a unqualified report. So you go to your answer book, and by the type of report, you will then write unqualified report. Then your reason would be because they said that it presents fairly. Cool. Then you have to explain why the auditor referred to pages 8 to 23. So that's over here. So the reason the auditor includes the pages is so that you know the pages for where the audited financial statements are in the report, right? Because the whole report won't be audited financial statements. So it's only these pages where the audited financial statements are found in the report, right? And then the second reason would be so that you know which pages the auditor was responsible for, right? So it's to know the scope of responsibility of the auditor, to know what the auditor was responsible for, and to know where the audited financial statements are in the annual report. Then we have to explain why the auditor referred to the International Financial Reporting Standards and the Companies Act of South Africa. Right. So that is over here. Cool. So the reason why the auditor would include this is to explain basically what basis they're saying it presents fairly, like what are they comparing it to. So they're saying it presents fairly, but based on what, right? So this is to say that they are compliant with both IFRS, the International Financial Reporting Standard, as well as the requirements of the Companies Act of South Africa. So then in your answer book, you will write that it's to explain that the company is compliant with both the local requirements, being the Companies Act, as well as international standards, which will be your IFRS. Cool. Lastly, we have to name any 2 items of audit evidence that the auditors may have used. So your audit evidence is basically your documents. So what documents would the auditor have looked at and inspected, and to verify that, okay, this information is presented fairly, right? So you just think about any type of document. So you would look at your bank statements if you're auditing the bank balances. You'll also look at your fixed asset register for your PPE. You can also look at your stock sheets. Another type of audit evidence that you can obtain is by doing physical verification. So doing an inspection of your fixed assets, or maybe doing an inventory count for the stock. Cool, so that is the end of question 1. I hope that it was informative and helpful. Please like the video if you enjoyed it and find it useful. Also subscribe to the channel so that you stay tuned for all the videos that come. Hit the notification bell as well, and leave a comment for any questions you might have. If there's anything maybe you need further explanation on, or any requests for which questions maybe you want to do, which topic you guys are struggling with. And yeah, bye.